Welcome to The Explainer. Today, we're going to talk about something huge. Literally, we're cracking open the financial blueprints behind the world's largest infrastructure projects. You know, the massive dams, airports, and power grids that pretty much define our modern world. So, how do these multi-billion-dollar projects actually get funded? Well, it's definitely not like just walking into a bank for a loan. We're talking about a whole different universe of finance with really specific rules and structures designed for each type of project. So, yeah, let's get into it. Okay, so here's the game plan. First, we'll look at why infrastructure is such an attractive investment in the first place. Then, we'll get into the nitty-gritty of energy projects and that big wild card, fuel risk. After that, we'll tackle social infrastructure, think hospitals and schools, and some really clever public-private models. And to wrap it all up, we're going to look at a totally different way of thinking about all this through the lens of Islamic finance principles. All right, section 1. So you've got these massive pension funds and insurance companies. Why on earth are they so in love with things like tunnels and power grids? What makes a boring old toll road so appealing to them? Okay, this right here is the golden rule of project finance. It's called non-recourse financing. What does that mean? Well, think of it this way. The project is like its own little island. If it sinks, the lenders can only claim what's on the island. They can't send a rescue boat to the parent company's mainland and start taking their other assets. This means every single one of these projects has to be rock solid, profitable enough to pay for itself over decades. It truly has to stand on its own 2 feet. And this is why those big money players love it. They have predictable cash flows, they last for decades, and once you build a bridge, it's not like someone's going to build another one right next to it. But the real kicker? It's that these things aren't tied to the crazy swings of the stock market. You know, a pension fund has to pay out pensions for the next 30, 40, even 50 years. They need income they can count on. And let's be honest, people are going to pay their water and electricity bills no matter what the S&P 500 is doing. This chart really spells out the difference, doesn't it? With stocks and bonds, you've got all that market volatility. Infrastructure? Much, much lower. But here's the trade-off. You can't just sell your piece of a power plant on your phone in 5 seconds like you can with a stock. And you know what? For these big investors, that's not a bug, it's a feature. That lack of liquidity is what gives them stability. It's the boring, steady anchor in the middle of a chaotic financial storm. Okay, so now let's talk energy projects, because this is where things get really interesting. Not all infrastructure is built the same, and when it comes to power, the source of that power, well, it changes absolutely everything for the lenders. You can basically split the energy world in 2 here. On one side, you have wind and solar. What's their fuel cost? 0. The sun and the wind are free, right? The big risk is just, can you get the thing built? But on the other side, you have things like natural gas or biomass plants. Now, the fuel is a huge part of your running costs, and it's unpredictable. Lenders are basically betting on the price of natural gas for the next 2 or 3 decades. Or they're betting that a cooperative of farmers can reliably supply wood chips for 30 years. That's a totally different and much riskier ballgame. And here's the crucial point. All that risk, that fuel supply risk, it translates directly into financial risk. Lenders are not in the business of just hoping for the best. They're going to charge higher interest rates to cover that uncertainty. The entire structure of the loan becomes more complex and more expensive. So right from the get-go, a project that needs to be fed fuel is just a tougher, pricier thing to get off the ground. Okay, let's switch gears again. Let's talk about social infrastructure. How does a government, which is always, strapped for cash, build a brand new hospital or a school? Well, one of the most innovative answers to that question is something called a public-private partnership, or PPP. And this is a really fundamental shift in how governments think about these things. The old way was, we build it, we own it, we run it. With a PPP, the government isn't paying to own an asset. They're paying for a service. They're paying for the promise that a hospital will be available and running smoothly. And guess what? All the big headaches, construction going over budget, delays, day-to-day maintenance, all of that risk gets handed over to the private company. So let's walk through how this actually works with a hospital. It's often a build, operate, transfer model. A private company finances and builds it. Then, and this is the key part, the government makes what's called an availability payment. They don't pay based on how many patients come through the door. Nope. They pay a fixed amount as long as, say, 700 hospital beds are available and up to standard. The private operator handles all the maintenance. Then, after maybe 30 years, the whole thing gets transferred back to the government. It's a genius system, really, because it means the private company's profit depends on keeping that hospital in perfect shape. All right, for our last section, we're going to take a look at something completely different. It's a whole other way of financing these mega projects, one that's guided by ethical principles of partnership and shared risk, instead of the traditional lender-borrower relationship. First up, you have something called sukuk, which are often called Islamic bonds, but they're not really bonds in the Western sense. When you buy a regular bond, you're just lending money. With a sukuk, you're actually buying a piece of the project. You get a certificate that says you own a small, tangible part of that asset. Maybe it's a few square meters of an airport runway. So you don't earn interest. You get a share of the profits that runway generates from landing fees. Then there's mujaraba. This is pure partnership. It's super simple, really. You have one partner who brings the cash and another partner who brings the know-how and manages the project. If it makes money, they share the profits based on a ratio they agreed on up front. But, and this is the critical part, if the project loses money, the financial loss is on the person who put up the capital. It's a real we're in this together model, sharing both the upside and the downside. And what about the actual construction? There's a special contract for that called istisna'a. The easiest way to think about it is like commissioning a piece of art. A bank or investor basically says to a construction company, I will pay you to build me this power plant. They pay in installments as the work gets done. Once the plant is finished, the investor owns it, and they can then lease it out. The beauty is, the entire construction gets funded without any interest-bearing loans. So you can see how the world is getting more creative with funding its biggest needs. The question really is, as we need to build more and more infrastructure globally, are these kinds of alternative models the key to a more resilient financial future? The next time you're driving over a new bridge or you see a wind farm on the horizon, maybe you'll think a little differently about the invisible, complex, and frankly fascinating web of finance that made it all possible.